This trade might be the first time I've actually heard of someone making money on a solar play, but here we go. The trade today that I'm looking at is on TAN, which is a solar ETF, and I think I'm going to be able to make a couple $100 over the next week by selling some options here. The idea being that the option premiums for TAN are high, and the way that I'm coming to that conclusion is by looking at it relative to the past option premiums and also by comparing it to the option premiums we're seeing for the stocks that actually make up this ETF. So let's take a quick look here. The first thing we'll do is actually, before we get into anything a little tricky, is just come over to the premium page here in the PA terminal. And let's take a look at the premium tracker for TAN. Let's actually change this to be the 10-day options, right? So IV 10-day, let's apply this. And we can see here for the 10-day options that we are still over that overextended line, which is the 90th percentile, right? That's that white dotted line there. And we know that option premiums mean revert, meaning if option premiums become really high, they come back down. And so we can basically place a bet here that option premiums will decrease in the future, bringing it back into line with maybe what we see as the average here, which is around 1.24, right? We're up at 1.36 right now. The next thing that we want to look at is, okay, well, compared to the past, option premiums on TAN do look pretty high. But if we come over here and we take a look at it relative to its holdings, right? I basically pulled up a list of its holdings, plotted the top three plus TAN itself. If we scroll down here and just simply look at the IV percentile, we can see that for the components, it's all around 18 to 30%, whereas TAN is up at 38%. Now, if I wanted to go even deeper into this, I could pull up more and more of the underlying components until we get down to ones that are maybe just like 1% of the ETF. But I think as a general starting point, given that this is a small, pretty quick trade, I think just looking at the top three to get a general idea of things is reasonable enough. We can see here that TAN clearly has a risk premium embedded into it. And I want to point out that this is not for no reason, right? If we take a look at TAN here, we can see that over the last month, it is down almost 8%. In the last 6 months, it's down almost 30%. This thing has been moving. But over the last, let's say 5 days, it's only down about 4%, and today it's basically flat. And the reason this is important is, as you'll see as we pull up this trade here, is that the break-evens for selling 1 week options are almost 5%, right? So if we come here, it's 5% to the upside, and to the downside, it's 5% to the up and downside here. So if we see a move less than 5% over the next week, we are going to be profitable on this trade. And for that reason, this is looking like a really good sell. Even though there has been a lot of movement, these risk premiums are so high that we can sell them now. And even if this thing continues to move at a pace that an ETF really shouldn't, we are still going to be able to make money. So that's the general idea of this trade. I did a quick analysis to look at how these other tickers I've been comparing have also been moving, and we see similar stuff. They've all been in a downtrend. Looks like the industry is just taking a bit of a hit, and that explains the risk premium that we're seeing. So what we're going to do now is we're actually just going to go ahead and structure a trade here. But to do that, the first thing we need to do is say, what do we think these options are really worth? So the way we're going to do that is by taking a blend of the PA forecast of volatility, the realized volatility over the last 10 days, and the realized volatility over the last 20 days. Right, so basically how much has this thing actually been moving recently, and what are we forecasting future moves to be from just a pure data perspective? We can see that the combined forecast is about 28%, whereas the implied volatility is about 38%, right, almost 39%. So what we're going to do now is we're going to come over here to our calculator, and we are going to say, okay, given that we think it's, what was it, about like 38.5%, was it something like that, right? We think that this straddle right now, right, the October 6th straddle, trading at the 52 strike, stock's currently at 52.15, should be trading for about $2.51. If we come over here and we take a look, we can see it's going for, about $2.57. That's totally perfect, right? It's, around 39% vol. That's cool. And so we could sell it today for about $2.57. And if all goes well, we think that vol should come down to around 28. So let's do that. And we think that this straddle should actually be going for $1.83. So on each straddle, if everything works out really well, we should make about what, $70? Yeah, about $70 on each straddle. So if we sell 2 of them, we can hopefully make about $140, $150 over the next week on this trade, right? Now, the reason I'm coming up with this $150 mark is I usually try to put about 1% account risk on each of these types of trades. And the PA account that we're trading live with the PA community is a $30,000-ish account. So that is how I'm coming up with the risk tolerance that I'm putting on this. Now, as for cutting losses, I'd probably cut my losses at around the 50, right, or the the 49.50 and the 54.60 mark, right? If we start to cross through those break evens to either side, I'll probably be looking to close out this trade. However, what's most likely to happen is we'll end up floating around somewhere in this range, and we'll pretty much hold right until the expiration of the trade. Now, if I get to a point where I can close out earlier and take that $70 per straddle, I will also go ahead and do that. So let's go ahead now that we have a good idea of how we're going to manage this trade, why we're going to make money on this trade. Let's go ahead and actually place the trade so you can see what the execution of it actually looks like. So we'll come in here to the option chain and we'll go to TAN. All right, let's pull that up here. All right, so we got the TAN option chain here. We're going to come here to the October 6th expiration, and we're going to structure out this 52 strike straddle, right, by hitting the bid here on these 2. We're going to change this to be 2 lots, and look, we can actually hopefully try and get a bit higher than that $2.57 fill. We'll start up here at 270 and see if anyone will hit us there. Most likely not, but I like to always start up there. All right, trade has been put into the market, and we are not getting a fill, of course, but that's okay. Let's see here if we come in and lower this to 265. No fill. We'll keep working the order down here. 260. It's most likely around the 255 mark that will get hit. Let's go ahead and give that a shot here. And we have gotten a partial fill on that order at 255. One of the lots has been filled, and there we go. Both lots have been filled. So what I'm going to do now is I'm going to go ahead and share that with the community. And if you're seeing this on YouTube and you want to ask about this trade, feel free to leave a comment in the comment box below, and I will happily reply to you. Besides that, good luck everyone with your trading, and we'll talk soon.